I was getting ready for this episode and kind of going through some of the top news stories on HousingWire this morning and over the last week. And mercy, there's a lot going on in the industry right now.
I'll say it's a very unique time, Clayton. Very unique time.
Well, I'm thrilled you're able to join us. I've had the pleasure of interviewing Phil Shoemaker before, and but excited to get you on Housing News and talk about the mortgage market and Homepoint and this eventful market we're working through. Hopefully there's some opportunities out there, but there certainly are challenges that I think we're all navigating. So we've had this podcast on the books for a little while now. I think like over a month. And since we set the plan to do the interview, the market's changed a bit. So how would you describe, I'll give you the laugh on that. So how would you describe the market we're working through right now? I'm sure you have to answer that question quite often, but how do you kind of describe what we're going through right now, Willie?
Yeah. Well, the reason I laugh is that it literally feels like you put together a plan and then a week later you say, well, all these variables have changed. Is this the right plan or not? So, normally plans are more like years, not months or even days to a certain extent. So yeah. I think, it's obviously very challenging. And I think there's a couple characteristics or I guess data points that really demonstrate that. I think one is, and there's a couple of graphs that are kind of been distributed in the industry. One is the gap between the trend in industry employment and the trend in production. So if you use like the MBA application index as one indicator of production, and then you have the overall employment in the industry, overall employment's down about 10% and production's down about 60%. So, to me, that indicates that we still have a ways to go to rationalize the capacity in the industry, which means there's going to be some level of, I guess, volatility and uncertainty, and whether it's production levels, margins, right sizing organizations, whatever it is. So I think there's still like a long way to go out there. The second is this whole confluence of housing supply, interest rates, the economic environment, employment, and it's for Clayton it's like not every indicator points to the same trend. So as an example, you have an employment which has been really strong, and then you have other indicators like housing, which has kind of gone now upside down from being very very strong growth, very strong home price appreciation to flattening out and even lowering in prices in some markets. So there's a lot of uncertainty and there's a lot of like mixed indicators out there. But I'd say overall, it looks like it's going to be a very challenging market into 23.
So that gap, 10%, employment being down 10% in the industry, but production being down 60%. That's still that's a huge chasm to cross. Do you think that there's operators that have just been slow to rationalize headcount, or is there hope that production turns around in Q1 and that gap closes through volume? Like, where do you think the operator, the IMB executive mentality is in thinking about how they anticipate that gap being closed?
Yeah, so I think it's gone from optimism about production now to more kind of holding on for, I'll say, better days in the longer term. Mm-hmm. And I think, when as an example, when rates were at 5 or mortgage rates were at 5, there may have not have been the same opportunity and from a refinance perspective for rate and term, but cash out seemed to still be of benefit to a number of consumers. And so it's like, okay, if I can do this for a period of time, kind of flip my production dynamic, then I can kind of work my way through. Now that rates are more like 7, cash out refinances are not even attractive for most consumers. And therefore, it's not kind of that, I'll say, bridge from this environment to, potentially kind of a more recovered environment. So I do think mortgage bankers generally tend to be a little bit overly optimistic. And that's probably because for a long time, we were to a certain extent bailed out by interest rates. So optimism was rewarded by recovery. Also, though, it does take a lot to build a company, build capacity. And it's very hard to let go of that when, you put all the work into it and you kind of have it the way you want it. We've had to kind of cross that bridge or maybe chasm at Homepoint, recently. And so I think it's hard for owners of companies and CEOs to say, I did all this work over the last 3 years or 4 years or 5 years to build this, and now I'm going to take it down.
I mean, as you think about strategies that you've employed or other IMB execs have employed to do what you can to reduce the cost burden of being essentially overstaffed where volumes are now, but try to maintain the ability or maintain the capability of production capacity if and when the market is in a different place without having to go through this kind of brutal recruiting ecosystem that we operated in for most of the last 3 years, where it was a battle for talent. We probably published a dozen articles about the battle for talent, and it's a little bit different now. How do you think about like the right way to not cut muscle and not cut into bone, but like maintain the culture that you've built, the capabilities you've built, but bringing the business back to a place that enables you to see the other side?
Yeah, so I'll give you a little insight on what we've done at Homepoint. So we have had substantial reductions in our workforce. We've tried to do everything the right way, whether it's how we let people go or how we make sure we're connected to the people that we retain. But I think for us, we feel like it's an opportunity in that we got to be a pretty big organization, and in that, sometimes it's challenging to extend the culture out when you're growing as rapidly as you are. Conversely, when you downsize, you have, frankly, just have fewer associates to touch. And so we're kind of personalizing things a lot more now with our associates because we can actually do that. So there's some things that, as an example, there's some things that I used to do 3 and 4 years ago from a video standpoint, from a interview perspective with our associates that I stopped doing because we were just too big to do it. And now I'm back to doing it, in part because that's what our associates asked. They said, we kind of want to do some of the things that we used to do when we were smaller. And we said, well, now we're smaller. So, why not do it? I think the second thing is that for us is that we're really taking this opportunity to reset the organization. And so when we grew rapidly, there are some things that we did in order to expand our capacity because the market opportunity was so significant that weren't quite as scalable or durable as we would have wanted them to be in a perfect world. But the opportunity was so great. And now what we can do, because we're not overloaded with volume, is we can actually engineer or re-engineer processes and leverage technology to a greater extent so that kind of next time it happens, we'll be in a better position to take advantage of it at a lower, more efficient kind of footprint.
I think our Housing News listeners are probably sick of me seeking out a solution to a more elastic mortgage market that knows how to flex up and down in different cycles. I think it's been I've used the word elastic in probably every episode in the last 20 weeks, but it sounds like you actually are pointing at a mission or a vision toward building a more elastic organization as you have the chance to think about re-engineering processes and introducing
it's so
new
funny,
technology.
yes. It's not, Clayton, it's so interesting that you say that because that's exactly how we're thinking about it. It's like we have to try to figure out how to get off the cycle of, massive ramp and then massive decline. We have to find some middle ground, and frankly, maybe it's you don't grow as rapidly when things are good so that you don't have to flex down as much when things are tougher. But, so maybe there's some of that too. Now, like I said, I will say that 2020 was just such a unique opportunity, especially for where we were at in our kind of, in our evolution that, we felt like we had to take full advantage of it. But yeah, I think the industry has to try to figure that out. And that's certainly where we're focused on.
I mean, there's lenders that have been criticized or kind of, like put in a box because they did a ton of refi volume and hired up really quickly to handle that refi volume. And I had a conversation with Anthony Shea about this, and I appreciated his perspectives. Like, hey, if a lender doesn't ramp up and handle the refi volume in a refi market, you leave millions of homeowners who should have had a refi and had a lower rate underserved. And so the industry did what it had to do to meet the market demand. And as painful as it is from an employment perspective and just business management and business valuation perspective, homeowners were served. And I it's hard to look in the rearview mirror and see that bright spot, but it does seem like it is a function the industry had to do. And it's a shame there's not a more elastic way to handle huge pumps in volume and serve the consumer, reap the benefits of cash flow, but also not have to totally reinvent organizations on the other side.
No question. I mean, I think if you think about it, we're the victim of our own success
Yeah.
because now there's no one to refinance. So obviously rates have gone up a lot, but yeah, I mean, if, as Anthony said, millions of homeowners were benefited from the industry's ability to ramp up capacity so quickly. But yeah, it would be more sustainable if we were to be able to figure out how to do it in a way that kind of that was less kind of violent on their ups and downs, on the ups and downs.
Yeah, yeah. If there was other levers to pull besides like purely adding headcount. So as you think about reinventing processes and implementing new technology, are there any specific areas of your business at HomePoint that you're focused on right now, where you think there's an opportunity to move the needle and the ability to have more capacity per team member?
So there's really two things. One is workflow, and so we've been for several years now working with a workflow tool called Appian. It's a kind of industrial strength, industry agnostic tool that allows us to move our users, our internal associates, kind of up a layer from the origination system into somewhere where we can more effectively kind of dictate the workflow, make it more consistent, make it more intuitive, tied into the rules engine that we use, such that the individual associate becomes more efficient and more consistent in how they do things. The next kind of horizon for us, and we've done some of this, but we're going to do more in 23, which is self-serve. So, as you know, our business is wholesale. And so the more we can extend services and processes out directly to our broker partners, the more flexible it is for them to be able to integrate it into their workflow. And the more we're really kind of delegating work to the appropriate place, so it doesn't have to be redone, et cetera. So, not only should that provide benefit for our broker partners and how they operate with us, it should provide benefit for us because we're not kind of redoing things that have already been done.
Interesting. Okay, so workflow, which impacts internal operations as well as impacting your broker partners. I want to come back to talk more about the broker partners. What are the other areas or other like core focus where tech and process can move the needle for your org?
Yeah, I mean, it's primarily that. I think so the self-serve is like the extension of the workflow to the actual broker partner. Yeah, it's fine. I'm sure the technology people would say saying it very simplistically, but the idea is that if someone has to send something to us for us to do, then by definition they're kind of fitting into our workflow. If we can allow them to do that online themselves or kind of enter into the process in a more efficient manner, then they can do it at the point where they feel like it's the most beneficial. And then for us, it kind of takes, like I said, it takes the burden off of us to perform a task or a series of tasks that may have already either been done or maybe be being done in a different sequence than is optimal. So those are really the two primary areas of focus for us.
Have you heard any kind of change in tone or change in ask from your broker partners and feedback loops about what they wanted, like in terms of service or tools a year ago versus like what they need support on today? Like, what are you hearing from broker partners on what they care about and how HomePoint can add value to them?
Yeah, I mean, certainly some product discussion. I mean, as an example, we're launching home equity next week. So that's probably, a good kind of product oriented example. But I'd say one of the things that we've really focused on in the last 6 months with a number of our broker partners is the assimilation of loan officers from retail to brokerages. And, there's been, I'm sure you've seen it. I know you've written about it. There's been a tremendous increase, every piece of, whether it's statistical, anecdotal, everything you see shows an increased migration of originators from retail to broker. And the brokerages want to ensure that they're assimilating those originators in the most efficient way possible. One, because obviously that benefits, kind of benefits everybody's bottom line. But also there's a tendency with originators, if they have a bad experience, they may kind of run back to safety, right? I mean, probably the biggest example of that was during, post-financial crisis when lots of originators ran out of broker and they ran into retail or bank retail more specifically because they felt that was like the safe haven. So a number of our partners are saying we want to ensure that, not only can we kind of source these originators, they can have a good experience up front and they assimilate effectively such that, there's no chance of them kind of, kind of like demigrating back into retail. So we spent a lot of time with a number of our partners helping design processes and kind of just focus on the new originators that are coming in that are converting over.
What are the market characteristics that you see right now that you believe are a proponent for originators moving from retail to wholesale?
Yeah, well, I mean, I think the thing I say is that the broker superpower is choice, and that is illustrated by the work that we and others have done to study the HMDA data. From 18 to 21. In 2018, the HMDA data was expanded out so that you can make a direct apples to apples comparison of all costs associated with the loan, between different channels of business, and you could also effectively identify different channels of business. And so, we went back and we looked at all that data. And as an example, in 2021, the average consumer that went to a broker saved $9,400 over going through through the average retail lender. So, I mean, and it's Clayton, it's every year, it's pervasive. And, people always ask why. And to me, kind of the simple answer is the broker superpower is choice. They have several lenders that they can go to. They can match up the individual consumer situation with the best lender for them. Whereas a retail lender has one choice. And that doesn't mean retail's bad. It just means that there's an inherent advantage when you have multiple ways you can go. And it also aligns the broker originator with the consumer in a way that's different and more effective. So, especially in an environment like this where every dollar counts and every loan counts, to me, it's a pleasant surprise that people are migrating as rapidly as they are, but it makes a lot of sense for them to do so.
Yeah. So what do you think that brokers that are recruiting people into their brokerages, so not like the 1 and 2 man shops, but the folks who are building some operations, what do you think the most important things that they need to provide are outside of choice? They're approved with their dozen or so wholesale partners, and they have kind of a swath of products from the conventional and conforming to non-QM. And, but like in terms of tech, culture, leads, like what else matters that these retail originators are going to value when they come over to the wholesale side of the market?
I think, again, in talking with the partners that we've worked with on this, it's really as much kind of almost demystifying or taking the myth out of brokerage. In that there's this idea that you lose control because you're doing business with a third party, and our broker partners who have done a great job converting over originators at scale show them how you not only do you not lose control, you're actually partnering with someone whose best interest it is to provide an enhanced level of service. And then it's observed by by whether it's turn times, cycle times, customer sat scores. It's really reinforced by all that. So I think it's almost not as much an offering because you set a lot of the table stakes types of things that have to be provided. It's really demystifying the process and kind of debunking the myths associated with doing business with a wholesale lender.
Yeah, I mean, you mentioned like understanding the market better through HMDA data. Can we go a little bit deeper at a little bit of the housing data nerd over here? Do you have a data science team that's like leveraging or analysts that's leveraging data directly from HMDA or working with different tools for HMDA access or research? Like, how does that process look like, and what tools are you leveraging to develop this understanding of the savings that you pointed to?
Yeah, we do. So we do have a data science team, and that's exactly what we did. We kind of unleashed them on the data. I mean, a little bit shame on us because for me, I'm very data driven from a kind of decision-making standpoint, Clayton. And we decided to go heavy in wholesale in 2018. And it was based on trends that we saw, but we didn't have the definitive data set that says, okay, these trends are backed up by an advantage that's sustainable, which to me, if you're best for the consumer, that's a sustainable advantage. So in 21, we were saying, okay, how can we prove this? And we said, wow, the HMDA data has this now. Now, it had it for a couple of years, but we just kind of figured it out. So we took our data science team and said, go into it. And it's not as simple as it sounds because you have to analyze the data. You have to find consistent cohorts that are large enough to be meaningful. But at the same time, that are kind of analyzable from a data standpoint. So in other words, it has to be consistency amongst your cohorts. And there's literally thousands of cohorts that you can slice and dice the HMDA data into. So it took our team about 6 months to come up with the initial data set and the methodology. And then we kind of vetted it out. We used third parties. We partnered with AIM to make sure that we were looking at this right. And then from there, we kind of evolved it. We looked at minorities. So, minorities saved over $10,300 in 2021 going through mortgage brokerages. So, it kind of went from there. But yeah, data science took a while. You got to understand the data at a very granular level. And, we had third parties look at it. And I'm proud to say that, kind of what we started is now kind of the industry standard for understanding the broker advantage.
You mentioned that you'll soon be launching a home equity product. When you look at the HMDA data, are there any other product trends that start to pop out at you that kind of get the wheels spinning on, should we be thinking about this product category or figuring out how we help brokers access a certain product category?
Not really. I guess the downside of the HMDA data is it's backwards looking. So you get we got 21 about 3 months ago, I think 3 or 4 months ago. So it's kind of hard to discern product trends because product trends are kind of so topical, especially in a rapidly moving environment. So it's probably not the best source for understanding product. But home equity was kind of a natural based on other statistical information that we saw. Most notably, of course, rates up in primary, but also the amount of equity that has been accreted over the last several years by homeowners.
When we watch our article engagement and then get anecdotal feedback from originators, we hear a lot of commentary and interest in non-QM and reverse mortgages, though neither of those are really showing up in the origination data yet. Reverse mortgages have their challenges. Non-QM lenders have had their challenges over the last 2 years. Do you see those product categories as being a more important part of 2023 and 2024, like overall product mix? Not necessarily for Homepoint, but like kind of thinking about the market.
Yeah, I do. I think especially non-QM. I think it's been tough for non-QM. Non-QM in a volatile capital market is a challenge because you eventually have to have that takeout. And I do know there are some investors that are stepping in. I'll call it more portfolio investors who are more wherewithal, who are stepping in. So that could help the market grow. But I'd say of the two, I would say non-QM is more likely to be, kind of have higher concentration. Also, as the agencies move kind of where their interests are, that's what creates opportunity in the non-QM market as well. Kind of, some people consider it niche, but 1% of the mortgage market is a pretty big niche. So you do that a couple of times and you get yourself in a pretty robust marketplace.
Yeah, that's interesting. Can you go a little deeper on what you mean by like where the agencies are headed of where their interest is? I don't know if I'm completely following that.
Well, I mean, you saw earlier this year that the FHFA mandated that the agencies change their LLP or low level price adjusters on second homes and a high balance. So you can see that there's a little bit more of a mission focus, from an FHFA/agency perspective. And that may be what creates additional opportunity in, kind of the outside the agency space. So whether you call it non-QM or not, to me, it's not, anything is not agency is not agency, right? So I think, if and as the FHFA continues to migrate down that path, that may create opportunity for the non-agency market.
That's interesting. How do you think there's an education curve for originators to feel more comfortable with those product categories, or any other kind of market headwinds on seeing kind of the non-conforming start to really take a larger piece of market share?
I think it's probably not my greatest area of expertise, so I'll probably be I hope I don't prove my own ignorance, but I think that the more consistent the market can become in those products, the more the originators will, even if they're more challenging to do, which they should be probably. I think that's the more the originators will be attracted to them. So, there's lots of flavors of non-QM out there, and maybe the more consistency that can be brought to the product, more comfortable originators will be with that.
Okay, cool. Well, let's move it on to another equally challenging topic and talk about how we're all watching the Federal Reserve's every move right now and listening to Jerome Powell. Can you give us some guidance on like kind of how you're thinking about Fed actions and Fed rhetoric and how that impacts your view on kind of the future of interest rates without exactly asking you to shake a crystal ball, but like how do you
people are really asking that? Like,
not asking you to shake, but how do you and the answer might just be like, hey, we don't predict interest rates, but like how do you think about what's happening with Fed and inflation with how you prepare your business?
Yeah, well, here's what I'll say is that we don't predict interest rates in that we don't take positions on what interest rates are going to be. Like, we hedge our pipeline, we hedge our mortgage servicing rights asset, but you have to kind of look at what you believe interest rates will be doing in order to plan your business. And so, like I said, we've taken actions such that, we're very defensive on the size of the mortgage market, put it that way. And that's a function not only of interest rates, but of inventory, of affordability, et cetera. So I think, I think the Fed's been a little bit wrong-footed on this for a while, right? So I think that they want to take every opportunity to get on top of this and ensure that inflation's not long-lasting. And it's interesting though, because what that does to long-term interest rates could be different than what it does to short-term interest rates. So we'll see. But yeah, we're not. We think the Fannie Mae forecast came out at 1.7 trillion. We think that's an important forecast.
Do you feel so 1.7 in total origination volume, which kind of shakes out to 4.5-5 million units? Is that kind of what their forecast?
That's right.
Yeah.
Yeah, that's right.
Yeah. So, I mean, we're seeing the market get cut in half, but still a sizable opportunity to go after. I feel like
that's right. Right.
Mindset's been a big part of this market. And I know there's like newer originators who have never had to go out and sell and fight for business. So as you think about like mindset that you bring forward as a leader and mindset that your AEs bring forward as they work with brokers, how are you kind of helping your team and pulling your team along with the focus on the horizon instead of getting kind of dragged down into the muck that we're wading through right now?
Yeah, I think there's a couple things we've done. One is we've taken the pressure off of volume a bit. So we've said, we used to kind of target volume numbers and we would, maybe float margins a bit more. And we said, you know what, we're going to be a little bit more disciplined on margins. We know that's going to affect volume, but let's do that. Now let's help everybody understand why. And so, that obviously that's not a message that 100% of our associates, especially on the sales side, are saying, hey, happy days are here, but it helps them understand we're kind of focused on the longer term and, maintaining a level of kind of a discipline associated with how we're operating. I think the other thing that we talk about a lot is like focus on the things you can control and do those as effectively as you can. And don't let yourself get caught up on all the things you can't control because, unfortunately in this business, Clayton, there's a heck of a lot of things you can't control. That's always been true. It's just that it gets exacerbated. The impact of those things you can't control gets exacerbated in an environment like this. So we just try to keep our associates focused on the things they can control and working together.
I mean, that's a topic that's come up a lot recently too, is focusing on the controllables. I think it was one of the most prominent topics at HousingWire Annual a few weeks back in Scottsdale. But something that's really hard for people to do. And personally, one of the things that like frustrates me the most when you go through conversations with colleagues, friends, family members who get so focused on the things they can't control. And, a lot of the stuff you see on, the evening news, like things that we can't control. So how do have you found any tactics or anything you've coached your team to, like what they can control and how they can focus their effort there?
I just think it's just a reminder. I try to keep the team on track. And so when we get off on tangents on things we can't control, I just kind of pull them back. So I don't know. I think a lot of things these days, Clayton, are not kind of very elegant from a strategic standpoint. I think it literally is every day going in and saying, okay, what is in front of me today? You don't lose sight of the longer term, of course, but it's like, what is in front of me today that I can control and impact on? And what are the things, as things come in and assimilate, let me filter them in a way that kind of almost categorizes them into what I can control and what I can't control. And if I need help in like cataloging that or prioritizing that, then that's when I reach to my peers or me as a leader.
Yeah, yeah, that's interesting. Reach to your peers. One of the most important learnings that I've had over the last few years, and it came from a peer CEO, was that we operate in a cyclical industry, and the minute that you can recognize that and build your operations and strategy around that is the minute that you'll start to accelerate. And I think there's a desire in a lot of investor and operator and entrepreneurial circles to want to avoid the conversation that some industries are cyclical, or like kind of like whitewash that and say like, oh, no, we're not. We have counter cyclical measures. But if you're able to embrace the market you operate in, I think that as an entrepreneur, you can start to operate differently and unlock value in different ways, and hopefully prepare yourself to build market share through a cycle versus, being the one that didn't have the balance sheet to support that.
Yeah, I think and you said it earlier, I think very effectively, which is like it is a cyclical business, and sometimes not growing is okay. It's like, and sometimes even optically, if the market's down 60% and you're down 50%, you actually grew in a sense. It's like, it doesn't feel like you grew, but you actually grew in a sense. So I think it is very much recognized. Again, it's like you don't want to focus on things you can't control, but recognize the environment that you're in.
Yeah. One of the trends that always comes up in cycles is people talking about consolidation. And we published an article recently with an interview of an advisor and banker to mortgage banks, who was suggesting that 30% of the 1,000 largest independents may disappear by the end of 2023 through sales, mergers, and failures. That's a huge number. I'm kind of hoping that's an overstatement, unless we see some players really step up and consolidate their way to serious market share. How do you think about consolidation in a market cycle like this?
Yeah, well, I think it's kind of a natural thing, right? I mean, if everyone's getting a little bit smaller, it doesn't make sense to consolidate, take advantage of the scale that you can have and efficiencies you can have by kind of bringing things together. I think in mortgage, it's probably more challenging than a lot of industries because there's a huge cultural component to it, and then there's different. The business models are quite varied, or can be quite varied. So it's not as simplistic. Kind of saying if you can buy number 2 and number 3, you'll get number 1. It's like, well, number 2 and number 3 may do business in entirely different ways with entirely different models and entirely different philosophies about it. So it's not as simple as saying like, since I'm in Michigan, put together Ford and put together GM and you'll have, you'll beat the rest of them. It's like, they make cars, but it's like a lot of us operate differently. But yeah, all that said, it would be a natural thing in an environment like this to see some consolidation.
And a big part of number 2 and number 3 or number 10 and number 11's culture might be competing against their closest peer. So you're bringing together peers who have not just at the corporate level, like you have 2 originators in Jacksonville, Florida, who've been fighting for business every day for 5 years, and now they're suddenly one. That's a not an easy dynamic.
Totally. No, that's very well said. It's very well said.
But it still seems like consolidation and M&A will be a big part of the next wave. So do you think like those deals work out best when you're not trying to combine like two like institutions, like merger of equal type scenarios where you have like a larger player who's picking off players in the $200 to $500 million like origination like volume level versus like the truly large strategic M&A?
Yeah, I mean, I don't know if it's easier or harder or more effective. It's just when you have large entities, obviously there's a lot of energy that is expended in order to consolidate. And so then you ultimately have to determine, is it valuable to do that? And usually the numbers say it is, but then the friction that comes in that period, may kind of start to erode some of the numbers. I think the smaller strategy, it tends to be simpler to execute on. Then the question becomes, how much value are you actually generating by doing it? So, I like everything. There's puts and takes, I think, to both.
Yeah. So if it's not consolidation, like what other levers have you seen successfully deployed in past cycles that have helped originators or IMBs build volume and build market share as we kind of navigate tougher market environments?
It's there's not much more. I
Okay.
think, there's occasionally there's innovation. I mean, if you look at crisis, you look at post crisis. There are obviously companies that are here today because they were able to take advantage of the post crisis environment. And one of the biggest things that I think benefited a number of those companies was HARP. Right when the HARP program came out, there are companies that are today that are very successful that very much leverage that program into growing beyond what they were before. So I think it's hard to say what those catalysts might be, but I'm not saying that there's kind of nothing that would happen kind of coming out of a cycle. I think it's a little bit like you don't know what it would be, but when you see it, you want to take advantage of it. And I think for us at HomePoint, that's kind of we're trying to position ourselves so that with the reset that we're doing, so that whatever trend evolves, and we think broker share is the trend that will evolve for us, that we'll be able to take advantage of it. So yeah, there may be something that comes. I don't think it's readily apparent right now, but I do think that there's a chance that something will come that someone will take advantage of.
I mean, I have to say, like you have focus, Willie. We're making a couple of key bets. Improve tech, improve processes, and broker market share grow. And it sounds like HomePoint's going to do okay.
Well, that's the plan. That's the plan, Clayton.
So, Willie, kind of to wrap up the conversation, as you look forward to 2023, what advice do you have for other mortgage operators? You have a long track record of success in operations in the mortgage industry. So I want to take some of the knowledge that you've gained and, pass it on. Like what advice do you have for folks that are originators or branch managers or other IMB leaders that adds value to the industry?
Wow. Okay, that puts me on the spot, Clayton. So I think it's what you said. I mean, it's interesting because for us at HomePoint, we focus on something, and we've placed our bets on brokers. Or our bet, I'll say, not bets, one bet, brokers, right? I think as an organization, make sure that you're focused on what you think is most important. And again, that could be a strategy, that could be particular technology, whatever it is. And it's like, don't try to do all kinds of things because the environment is so uncertain. I got to do this and I got to do that and I got to do the other thing. I got to do everything. It's like what has benefited me in my career and what we believe will benefit HomePoint is to stay focused on what you think is most important, where you think the greatest opportunity is. Maybe not tomorrow, but as we exit this cycle and get into a cycle that you can take advantage of.
All right. Thank you. I'm going to take that advice of focus and bring it into my own life.